Welcome to The Explainer. Today, we're going to pull back the curtain on a corner of Wall Street that's gotten so big, so fast, and so secretive that even the biggest names in finance are starting to get really nervous about what's hiding in plain sight.
Okay, so what does that even mean? Well, that's the warning from Jamie Dimon, one of the most powerful people in finance. And he said it right after a few companies that looked totally stable suddenly went belly up. It's a classic Wall Street saying, when you spot one problem, you can bet there are a lot more you can't see.
So what's this cockroach everyone's worried about? It's something called private credit. And this isn't just some small issue. We're talking about a multi-trillion-dollar industry that has absolutely exploded in size, all while operating in the shadows. Most of us have never even heard of it, but it's quietly weaving itself into the entire global economy.
To really get a handle on how we got here, we have to rewind the clock back to the last big financial meltdown. You see, the story of private credit actually begins in the ashes of the 2008 crisis and the wave of new rules that came right after.
So picture this. After 2008, a ton of new rules made it way harder for big banks to make risky loans. But, companies still needed to borrow money. So a new group of lenders, we're talking giant investment firms and private equity funds, they just jumped right in to fill that gap. They basically built a whole new banking system, one that operates outside the old rules, in the shadows.
And just look at how massive this shadow system has become. I mean, we are talking about a market that's projected to be worth nearly $5 trillion by 2029. That is a staggering amount of money just flying around outside the traditional, regulated banking system we all know.
But here's the thing. This is where it gets tricky. That explosive growth is exactly what has experts on edge. Because the very things that make private credit so attractive, well, they're also its biggest weaknesses. And this really gets to the heart of the whole thing. It's a paradox. On one hand, private credit is this vital engine for the economy, right? It funds innovative businesses that banks might turn away, and that helps create jobs and growth. But on the other hand, it's a total black box. It's barely regulated, it's not transparent at all, and there's a huge potential for some serious conflicts of interest.
Okay, and here's the real kicker. This is the core of the problem. Think about the stock market. Prices are public, set by millions of buyers and sellers. It's transparent. But in private credit? Nope. The lender basically gets to grade their own homework. They're the ones deciding what their loans are worth. And as Professor Defontier points out, that creates a massive incentive to just pretend everything's fine even when it really isn't. And listen, this isn't just some theory, some what-if scenario. We've already seen how this can blow up in the real world, and let me tell you, it is not pretty. Let's take a look at a recent case that sent some serious shockwaves through the industry. So, this is Renovo, a home improvement company. Major private credit firms had loaned it money, and according to their own books, the loans were perfect, valued at 100 cents on the dollar. Absolutely zero risk, right? And then, in what felt like the blink of an eye, it was worth nothing. The lenders marked the loan all the way down to zero, a total loss. And this raises a terrifying question. How many other perfect loans are out there that are just one bad day away from being completely worthless? So right now you're probably thinking, okay, that's bad, but this is a problem for some niche lenders, right? This doesn't really affect my bank. Well, hang on, because the truth is way more complicated and way more concerning. This number right here, this is the key to understanding the real risk. Over $1 trillion, that is how much money our traditional regulated banks have loaned to the shadow banking system.
Just think about that for a second. The very banks that are supposed to be playing it safe because of the post-2008 rules, they're actually bankrolling the unregulated system that grew up to replace them. Even Jamie Dimon's own bank, JP Morgan, is deep in on it. This means the risk isn't contained in the shadows at all. It's a feedback loop. If private credit has a meltdown, it could take the traditional banks right down with it.
So what we have now is a brand new, completely untested fault line running right through the heart of the financial system. It's like we've built this giant skyscraper on a foundation that we have never, ever stress tested.
You see, if a regular bank starts to go under, we have a plan. Regulators know what to do, there's a fire drill they've practiced for decades. But if the private credit market starts to implode, we've got nothing. No playbook, no plan. It would be like trying to perform surgery in the dark with no tools.
This is exactly why some of the sharpest minds in finance are starting to lose sleep over this. We're talking about legendary investors like Jeffrey Gundlach, who are now saying out loud what a lot of people have been whispering. The next big financial crisis could be born in this murky world of garbage loans.
So, what's the bottom line for you in all this? It's actually pretty simple. A huge, incredibly powerful part of our financial world has been built in the dark. It's connected to everything, but we have almost no idea how stable it really is. And there's no safety net if it all comes tumbling down.
And that leaves us with a really chilling question. We sort of saw the last crisis coming, and we still couldn't stop it. This time, we might not even see the signs at all. So the next time you hear about a cockroach on Wall Street, you'll know to ask, what else is hiding in the walls?